Hello everyone, welcome back. Did you read today's article, U.S. Regional Banks Hit by Credit Shock? It covers a wave of renewed stress in smaller American banks after several lenders revealed large bad loans and fraud-related losses. Stock prices fell sharply, liquidity concerns resurfaced, and analysts warned that even a few weak loans can shake confidence in the entire sector. The situation raises big questions about risk management, regulation, and what responsibilities banks and governments should have. Today we'll start with a quick quiz and then discuss whether governments should intervene to protect investors when banks make poor lending decisions. Let's get started. Let's take a closer look at today's story by checking your understanding with a short quiz. You can pause if you need more time to think. Ready? Let's get started. First question, what triggered the sharp sell-off in regional bank stocks? A. A rise in interest rates. B. A drop in consumer spending. C. A major cyber attack. D. Large bad loan and fraud disclosures. Take a moment to think about it. The correct answer is D. Several lenders revealed big losses tied to defective loans and alleged fraud, which immediately shook investor confidence. Number 2. Which sector is mentioned as a major pressure point for regional banks? A. Technology startups. B. Renewable energy. C. Commercial real estate. D. Retail banking. Consider your answer carefully. The correct answer is C. The article highlights weakened underwriting standards and falling asset values in commercial real estate. Time for a quick true-false quiz. Number 3. Depositors remain fully protected by federal insurance up to $250,000. Think about your response. The answer is true. The article confirms that insured deposits remain safe despite broader market stress. Number 4. Larger banks are facing greater contagion risk than smaller ones. Reflect on your answer. The answer is false. Analysts say larger banks are better prepared, and the vulnerabilities lie mainly with smaller regional lenders. Having explored the article through these questions, let's now engage in a discussion to delve deeper into the themes presented. Consider the following question and share your thoughts. Here is a question for you. Should the government step in to protect investors when banks make bad lending decisions? That's a complex question, and people tend to answer differently depending on their views about personal responsibility and systemic risk. What do you think?
Well, in my opinion, governments shouldn't automatically rescue investors every time a bank mismanages risk. Investing always involves a degree of uncertainty, and people who expect rewards must also accept the possibility of losses. If the government steps in too often, it can create moral hazard, encouraging risky behavior because the consequences are softened. That said, there are moments when intervention is necessary, not to protect individual investors, but to prevent a wider financial collapse. If one bank's failure threatens to destabilize the entire system, the government has a duty to step in and maintain stability. Still, I believe support should be targeted and temporary, ensuring the system survives without rewarding irresponsible decisions.
Great work today. This article reminds us that financial stability is a delicate balance between accountability and protection. As you move through your day, consider how much risk you think is acceptable, and who should bear the cost when things go wrong. See you next time.